This is a very rapid overview of using the target and valuation models, and it's this is going to be very rapid, not meant to go into any details, but these are tools, both that I've developed um, on the target next day target pricing and the valuation model, and then just combining that with stuff that's just out there, very, very well known, common stuff. So, again, right now we're looking at December 5th, 2012. Um, it's 4 in the morning. This is a 24-hour market. We're looking at the Australian dollar priced in Japanese yen. As you can see, the yen prices right now, right over here. But what we're buying and selling is the Australian dollar. And here are the price projections for that were cast late yesterday afternoon for going through to today. The valuation, which we've already discussed, is sitting actually 1.5 times the upper standard deviation. Has been descending, so it's a combination of having almost made it to the upper target for the day, didn't quite make it, and it's starting to this is a setup for taking some shorts, just kind of working your way, taking positions in this top congestion area. We're going to see how that's done as we kind of really zero it down. I'm going to jump now to really big picture down to really small picture using a couple different types of charts. If I can get the toggle to work, there we go. We're looking right now at, again, this market going all the way back to 2003. And what I'm focusing on right now is, and you can see how it's, big drop off during the market crash, 2007, 2008. Big rally, and now this several year congestion area right in here. I'm actually going to be focusing in on just this spot right here. We're looking at around June of 2012. This is August of 2012, and this is October of 2012, right up to present time. And it may look ridiculous, but we're going to keep blowing this section up right here. If I now go from a weekly, we're going to flip over to a daily. Here's your June, here's your August, there's your October. Now we're going to flip from a daily to basically a 360-minute. Every bar represents 360 minutes. So if I expand this a little bit, you can see the individual bars. I'll compress them again. Here's your June, your August, your October, right there. June, August, October. From here, from a 360, we're going to expand it again. Now we're looking at a 120. So the 360, obviously a 6-hour bar. Every bar represented a 6-hour time frame. In this case, it's a 2-hour time frame every bar. Again, if I expand it, you can see the individual bars. I'll compress it again. There you go. Now we're just looking, since we've scoped in, now you're just seeing the August top, the October bottom. And this is just simply going and taking a look at we're doing trend lines we're always looking at where are we right now relative to what's occurred in the past. So when you're doing these trend lines, as this time passed by and this failed, it came up, rallied and failed, you can start, then you do look at it in hindsight. You're saying, well, okay, based on history, recent history, um, what is this market showing us in terms of what traditional technical traders would call, trend line support resistance levels. So you know that lots of money is moving around the world based on people who do technical analysis. So it's the old routine. You do not fight the trend. You let the trend be your friend. But in the context, that doesn't mean you can't go opposite the trend, taking short positions in an up market, but you do that very carefully, judiciously, and for short periods of time. We're going to go from this 2 hour, now we're going to blow this up even more. What we're going to be flipping to, these are time bars. We're going to flip to something called, we're going to be using tick charts and envelope those prices in the context of what's called a Keltner channel. I'm not going to go into Keltners right now as to what they are, other than maybe just to generally say that the individual that developed this algorithm was eliminating time as a factor and just looking at volatility levels as to where would a market basically be in terms of its volatility, where would the tops and bottoms be when not considering time, just volatility levels. But that's for a whole other discussion we're not going to get into right now. What we're looking at right now is a 120 tick bar chart. So I'll expand it and then contract it. Every bar, high open, high low close bar, is comprised of 120 ticks or trades. Every time a trade occurred, boom, it was recorded. So and you'll notice that, and well, you're not going to notice it right away here at all, but do you have uneven, the x-axis, while it posts the times, if I broke this down and showed you even spacing, from here to here, and then took that space from here to here, but then looked at the x-axis, you would notice that the time elements for any, in fact, I'll do this right now, go take a rectangle, just any old rectangle will do. If I took the prices or the times off the x-axis from here to here, and then simply I'm going to copy, maybe I'm not going to, well, basically, I think you get it. I'm going to do a drawing here, don't want to take too much time on this. But simply take it from here to here, take these items right here. Now I'm going to grab this and move it over. The time frame from here to here, and the time, compare that to the time frame from here to here, and you will find that they are different time frames. So the x-axis is really an uneven axis in terms of spread from left to right. Why? Because we're really only compiling these trading bars per number of trades taken. So it's about all I'll say right there. Let's take a look at, and I'm going to scope this down. This is a 1200, 800 tick bar, 600 tick bar, 400 tick bar, 200 tick bar, 25 tick bar, 10 tick bar. And you'll notice there is order all the way down. I'm going to flip through all these charts again just so you get an idea of the orderliness of the market, and the fact that what you're doing is using these tools for finding best entry spots, depending on your bias, whether you want to go long or short. So we're going to flip through the whole thing again quickly and end this video. Take a look at, again, here's where we are right now, looking at this market already having basically topped out. Here was the weekly chart, the daily chart, the 6-hour chart, 360 minutes, the 2-hour chart, 2-hour time bar chart, flipping over to tick charts. That was the 12. This is the 800, 600, 400, 200, 25, and 10. And the last thing I'm going to show you as I go back through these again is you will, I'm going to go and I'm going to scroll one full page at a time backwards to November 9th. Here we are, November 9th. Again, way undervalued. Almost, this is almost 3 standard deviations, certainly 2 on the valuation. On the lower end of the valuation, it hit right down to the bottom of the target pricing. And I'm going to flip over to the 9th. Let's see if we can find it over here. There's the 9th, that bottom right there. That bottom right there. Jockeying for position. I was jockeying for position and was able to identify that bottom to grab that. Eventually, just recently taking it off. So again, we get into the fine tuning. In fact, using this method, I was able to identify the bottom going back to the October, taking that through, and eventually doing some jockeying when it started getting into the overvalued evaluations, jockeying for position, getting back in, and just recently taking it off, even attempting a little bit of shorting there, but laid off on that. So that's all for now. We'll talk to you later.